Greetings and welcome to the third quarter fiscal year 22 earnings call. During the presentation, all participants will be in a listen-only mode. Afterwards, we will conduct a question-and-answer session. At that time, if you have a question, please press the 1 followed by the 4 on your telephone. We ask that you limit yourself to one question and one follow-up. If you need to reach an operator during the conference, please press star 0. As a reminder, this conference is being recorded Monday, February 7th, 2022. I will now turn the conference over to Megan Cochard, Director of Investor for Novelis. Please go ahead.
Thank you, Kathy, and good morning or evening, everyone. Welcome to Novelis' third quarter fiscal year 2022 earnings conference call. Hosting our call today is Steve Fisher, our President and Chief Executive Officer, and Dev Ahuja, our Chief Financial Officer. Following the presentation, the call will be open to analysts and investors for questions. This conference call is being broadcast on the internet at novelis.com in the Investors section. A replay of this call will also be available on our website. Before I turn the call over to Steve, let me remind you that today's earnings release and presentation include forward-looking statements as defined in the Private Securities and Litigation Reform Act of 1995. These statements are subject to risks and uncertainties. These risks and uncertainties include, but are not limited to, those factors identified in the release and in our filings with the Securities and Exchange Commission. Today's presentation also includes certain non-GAAP measurements. Reconciliation of these measurements is provided in the financial statements included with our earnings release, as well as in the appendix of our presentation. Now let me turn the call over to Steve.
Thanks, Megan, and good morning or evening, everyone, and thanks as always for joining us today. Nearly 2 years later, the coronavirus pandemic continues to challenge our employees, customers, and suppliers around the world. But I couldn't be more proud of all the hard work being done and solutions being implemented to ensure the health and safety of our employees and communities and the continuity of our business. Global flat-rolled aluminum markets remain very robust across the board. However, global supply chain disruptions exacerbated by COVID-related lockdowns and the fast-spreading Omicron variant have created an increasing number of headwinds in the flat-rolled aluminum supply chain this fiscal year. While there's much uncertainty, we expect these headwinds to continue for some time. However, as evidenced by our strong underlying third quarter financial results, our teams are deftly navigating these challenges and their associated cost pressures. Despite the challenges, Novelis continues to generate strong free cash flow and has reduced its net leverage position to 2.3 times at the end of Q3, a full turn improvement in the past 1 year. I am also very proud of all the excellent work to integrate Alaris operations and systems into Novelis since closing the significant acquisition less than 2 years ago. We have achieved $107 million in run rate combination cost synergies through the end of Q3 and remain on track to exceed $120 million in combination synergies. We also expect to achieve at least another $100 million in strategic synergies by integrating operations in China once our recycling and rolling expansion there is complete. With our firm financial footing, diverse product portfolio, proactive global procurement team, and strong customer relationships, we are equipped to continue to limit the impact of supply chain disruptions and inflationary cost pressures. At the same time, we are implementing several strategic capital growth plans to capture robust long-term demand for aluminum flat-rolled products and achieve our sustainability goal to be carbon neutral by no later than 2050. Let me talk about the strong demand trends we are seeing across end markets here on slide 4. With the exception of uncertainties related to the semiconductor shortage impacting the automotive industry, our demand outlook across our product end markets for the 2022 calendar year remains positive. Beverage can demand remains very robust, driven by consumer preference for sustainable packaging options and package mix shift towards infinitely recyclable aluminum. We continue to expect strengthening customer demand for the foreseeable future as can makers have announced plans to add new capacity over the next couple of years across regions. In automotive, the mid to long-term outlook remains robust, supported by growing consumer demand for vehicles that use a higher share of aluminum, like SUVs, trucks, and electric vehicles. However, the semiconductor shortage impacting the automotive industry is having an impact on demand for aluminum sheet. We continue to monitor the impact the global semiconductor shortage is having on our customers, and we are prepared to meet their ongoing production needs. Moving to specialties, customer demand is strong across end markets, including building and construction, consumer electronics, and container foil packaging. We also see strong demand for aluminum battery enclosures due to the rising demand for electric vehicles. And finally, demand for the premium aerospace sheet from OEMs is expected to improve off recent year lows. Long-term demand fundamentals remain intact, and we are seeing order bookings improve, but the recovery could be prolonged or uneven. With that, I'd now like to turn the call over to Deb for a detailed review of our Q3 financial results.
Thank you, Steve, and good morning or good evening. So turning to slide 6, net income from continuing operations grew 33% over the prior year to $259 million in Q3. Excluding tax-affected special items, as outlined at the end of today's earnings press release, net income from continuing operations increased 15% to $241 million, mainly driven by lower interest expense and unrealized derivative gains during the current quarter. Net sales increased 33% to a record high $4.3 billion, primarily driven by higher LME aluminum prices and local market premiums as compared to the prior year. Q3 flat roll product shipments were 930 kilotons, which was essentially flat compared to the prior year due to supply chain bottlenecks, semiconductor shortages impacting the automotive industry, and unplanned downtime in our South American operations impacting global material flow. Q3 production was also impacted by a temporary strike in Asia, but the impact on third quarter shipments was largely contained by the use of available inventories. Slightly higher aerospace shipments and automotive shipments, despite semiconductor constraints, were offset by lower can shipments, while specialties were flat. Adjusted EBITDA grew 1% to $506 million compared to $501 million in the prior period, which included a $25 million customer contractual obligation benefit that did not recur this year. Adjusted EBITDA per ton increased 1% to $544 in the third quarter. Turning to the EBITDA bridge on slide 7, that $25 million customer obligation in the prior year that I just noted is reflected in the other column here. Excluding this prior year benefit, the underlying 6% improvement in adjusted EBITDA year over year is primarily a result of better price and mix and favorable metal benefit mitigating inflation and supply chain disruption costs. Despite semiconductor constraints, automotive shipments grew year over year, while can shipments were lower, leading to overall favorable product mix benefits. We also benefited from higher prices resulting from favorable demand dynamics in the can and specialties market, as well as some inflationary cost pass-throughs. Like most companies, Novelis is experiencing inflationary cost pressures resulting from global supply chain disruptions. This is impacting the availability and price of materials and services across the board. We have adequately prepared ourselves to maintain current production levels and service our customers, but still face a very challenging and uncertain supply chain environment. While our near-term results are impacted by these higher costs, we have been able to limit a meaningful amount of the inflationary impact through a combination of some cost pass-throughs, favorable pricing due to a strong demand environment, hedging activities, and increased recycling benefit. The $14 million increase in SG&A and R&D is mainly from higher forfeiting activity, offset by a favorable $15 million currency benefit, driven mainly by a weaker Brazilian real. Let's turn to slide 8 and Q3 performance year-over-year by segment. North America shipments increased 3% year-over-year as supply chain disruptions and semiconductor chip shortages constrained our ability to drive higher shipments. While automotive shipments remained constrained due to the chip shortage, they were still the main driver of the shipment increase year-over-year. Adjusted EBITDA declined 12% due to supply chain disruptions, capacity constraints, and scrap tolling disruptions, increasing expensive external sheeting at purchases and driving unfavorable metal mix. Other cost pressures from inflation, mainly from freight and alloys, were partially offset by higher volume, better price and product mix, and favorable recycling benefits. Europe shipments were flat as strong demand for can and specialty sheet and improving aerospace and commercial plate shipments were offset by lower automotive due to semiconductor chip shortages. Reported EBITDA was down 28% versus the prior year, but down only 3% when excluding the $25 million prior year contractual benefit. Inflationary cost pressures, mainly from higher energy, exacerbated by geopolitical tensions, were mostly offset by favorable metal costs and better price and product mix. Turning to slide 9, Asia shipments declined 8% year-over-year due mainly to supply chain bottlenecks impacting can shipments. While we had a temporary strike in our Asia operations, the impact in Q3 was largely contained by servicing customers from available inventories. Automotive shipments grew slightly year-over-year, but remained constrained due to semiconductor shortages. EBITDA was down 3% due to supply chain disruption and inflationary cost increases, mainly coming from elevated ocean freight costs and utilities, partially offset by favorable product mix and metal costs. Lastly, South America shipments were flat due to some unplanned equipment downtime at our Pinda plant during the quarter. EBITDA grew 38%, driven by several favorable factors, including metal costs, product mix and pricing, currency, and favorable tax litigation settlements, partially offset by higher operating costs due to inflation and forfeiting. Now let's turn to cash flow on slide 10. Year-to-date, free adjusted cash flow from continuing operations was $217 million compared to $331 million in the prior year. Significant working capital pressure from rising LME prices and local market premiums in fiscal 2022 created an approximately $500 million year-over-year negative impact. In addition, the supply chain disruptions and higher transit times we have been discussing have required higher inventory levels. Increased working capital was partly offset by higher adjusted EBITDA, favorable metal price lag, and timing of capital expenditures. We now expect full-year fiscal 2022 capital expenditures to be approximately $550 million, down from the previously guided range of $600 to $700 million due to a shift in expected timing of capital spend. Our net leverage ratio further improved to 2.3 times at the end of Q3, and we continue to maintain adequate liquidity levels, ending the quarter with $2.3 billion. Lastly, subsequent to fiscal Q3 in January, Novelis entered into a $315 million unsecured short-term credit facility maturing in November 2022. Proceeds of this loan were used to repay the entire outstanding $315 million secured term loan facility due June 2022. I'd now like to turn the call back over to Steve.
Thanks, Dev. Now, turning to capital investments on slide 12. Novelis has a long, successful track record launching and safely ramping up large capital projects across the globe, and we're very excited for the next phase of growth here. Our most recent examples of successful expansions are the 3 large organic growth projects completed in recent months. New rolling and recycling capacity is now in place in Brazil to support strong demand for aluminum beverage cans in a market that continues to see healthy growth. Meanwhile, the recent completion of our newest automotive finishing lines in the U.S. and China have expanded our total automotive finishing capacity to approximately 1 million tons globally. Both facilities are now producing commercial shipments, and we continue to work closely with our customers on material qualification to meet strong demand. We are now starting a new wave of investments, and since October 2021, we've announced approximately $900 million in new capacity projects. First is the $375 million investment to expand rolling and recycling capabilities at our Xinjiang plant in China. The upgrades will also allow for the implementation of valuable closed-loop recycling partnerships with our automotive customers, supporting our purpose of shaping a sustainable world together. At the same time, the expansion will free up rolling capacity in South Korea to meet growing demand in specialties and beverage cans. This expansion which will integrate our Xinjiang and Changzhou plants in China, is a key strategic synergy of the Alaris acquisition, and forecast to provide more than $100 million in strategic synergies when complete. Second, we announced plans to invest approximately $130 million to upgrade and debottleneck operations in Oswego, New York, to meet growing customer demand for sustainable aluminum flat roll products. The project increases hot mill capacity by approximately 124 kilotons to serve growing in-market demand and enhances the plant's ability to produce high-quality automotive sheet. And last month, we announced a $365 million investment to add a new state-of-the-art recycling and casting center focused on recycling automotive scrap in Guthrie, Kentucky, taking us a step closer to our sustainability goals. This new recycling investment will increase our scrap-based casting capacity in the U.S. by approximately 240 kilotons, increasing the amount of recycled content in our products while decreasing carbon emissions for Novelis by an expected 1 million tons annually. Beginning to commission in 2024, this facility will include advanced scrap sorting technology and allow us to grow closed-loop recycling programs with automotive customers in North America. Let's turn to the next slide. As the world's largest recycler of aluminum, sustainability has always been a core part of our business. Recycling and increasing the use of recycled content is the cornerstone of our sustainability journey, and it is projects like this that will pave the way toward achieving our ambition to create a fully circular business. Our ultimate aim is to improve the circularity of aluminum by consuming more of our customers' production scrap and end-of-life scrap. Using recycled aluminum as an input material requires only 5% of the energy used to make primary aluminum, thus avoiding 95% of the carbon emissions associated with production. As such, the investment is an important step to achieving our goals of a 30% reduction in carbon emissions by 2026 and carbon neutrality by 2050. Now, before I open the call to questions, in summary, Novelis delivered a strong quarter amidst a number of macroeconomic and supply chain challenges, delivering value through acquisition synergies and launching significant strategic projects to capture favorable demand trends for aluminum flat rolled products across end markets. We see many more significant opportunities to continue to invest and grow with our customers and work towards achieving our ambition to be the world's leading provider of low-carbon, sustainable aluminum solutions. And with that, we're happy to take your questions.
Thank you. If you would like to register a question, please press the 1 followed by the 4 on your telephone. You will hear a 3-tone prompt to acknowledge your request. If your question has been answered and you would like to withdraw your registration, please press the 1 followed by the 3. Again, we ask you to have 1 question and 1 follow-up question. One moment for the first question, and it comes to the line of Carl Blunden with Goldman Sachs. Please proceed.
Hi, good morning. Thanks for the time. You've been operating very well over the recent quarters and generating a good amount of cash. I wonder if you could touch on your capital return goals. Maybe it's to shareholders, maybe there's some capital allocation towards M&A. I'd be interested in what the balance, right balance is for the business going forward.
Sure. It's a good question, and as you might recall, we did put out a capital allocation framework last spring, and so I'll let Dev just kind of walk through what that looks like, and really there's no change from it. But Dev, you want to walk through the capital allocation framework?
Yes. So on the capital return policy, as we had announced in the middle of last year, we will be returning about 8 to 10% of cash post maintenance capex and before growth capex, and in line with that, we sent $100 million of capital back to the parent, and this really reflects the expectation for the next many years. We think that based upon the best visibility we have, we will be returning capital of about $100 million or around that for the next foreseeable number of years. So that is really on the return of capital. And can you again repeat what more you wanted to know?
Yeah, I think that was helpful in terms of return of capital relative to debt reduction. I think you've been clear on that. Just, I think the follow-up would be on M&A. What's that environment like? What's your appetite for M&A at this point?
Yeah, I think, after digesting the Alaris acquisition and some of the regulatory constraints that we saw, both in the U.S. and in Europe, it's difficult for us to see any large-scale M&A activity. I think we'll be much more focused on organic growth investments, which we just walked through and highlighted, $900 million that have been announced since October of 2021, and potentially some smaller investment activities, but be around access of technology or something in innovation space than it would be in a large-scale M&A going forward.
That's very helpful. And then just on those organic investments, are you seeing significant upward pressure on CapEx, or is there a way to manage that relative to your initial CapEx expectations? I did note the deferral in CapEx to later periods, but in terms of the overall bill that you might expect.
Yeah, I mean, I think obviously the announcement of China, the new recycling center here in the U.S., and the expansion at Oswego, they're all just getting underway. You did see some deferral of CapEx that Dev spoke of that will spill into next year. So I think the expectations of capital expenditures for next year will be higher than this year. But as we finalize our plans, we'll certainly give more guidance next quarter.
Thanks for all the time. Appreciate it.
Mm-hmm.
And our next question comes from the line of Prashant Koda with Dolet Capital. Please proceed.
Hello, sir. Thanks for the opportunity. The question is regarding, is not necessarily related to this quarter, but then what explains the profitability difference between the European business and the other regions? Is it largely to do with a higher employee expense in Europe, or is it just a mix? So if you could broadly enlighten us, what part of the profitability difference is explained by mix differences, and what part of it is because of higher employee cost, if at all it is? Thank you.
So, it's difficult to have parity on profitability across regions. The commercial environment is different, the demand environment is different, and so really to start comparing becomes a bit of a challenge. But to be more specific to your question, both from a pricing environment and a demand environment point of view, North America has a lot more favorability as compared to Europe. So it is really everything. I mean, North America has a better mix. The markets are a lot more supportive from a demand perspective. Pricing levels in general are more favorable in the North American market. These are really some of the headline factors because of which profitability between the two markets differ, and it will continue to differ. That has always been the case, and we expect that to be the case in future.
Sure, sir. So just a small follow-up on that. What would be the employee cost of our operations in Europe and US and other regions? So if you could just, out of the $1 billion odd employee bill that we have, employee expense bill, if I'm not wrong, what proportion of that is in the Europe?
So we will not share specific regional data, but let me say this, that there is not a material difference in the cost per person, cost per head count between the two regions. That's all I can tell you.
Thank you, sir. That's helpful.
And our next question comes from the line of Sumangal Nevatia with Kotak. Please proceed.
Thank you for the opportunity. First is one clarification on South America division. That a line mentioned that there are some tax litigation settlement benefits, if one can quantify that. And secondly, overall on the South American business, I mean, we are seeing margins is going through the roof every quarter. If you can just share some more light on this, how do we look at coming quarters? Is there any unsustainable tailwind which we are currently benefiting and which might start reversing in coming quarters?
So in South America, we are really benefiting from the higher metal prices. That's one of the big drivers of the current, tailwinds that we see in the EBITDA per ton. And also the demand environment in South America is doing very well. In this quarter, we also had a good mix of, can versus specialties shipments. So these are all the factors that are resulting in a more favorable EBITDA per ton. Now, as far as your point about litigation is concerned, in this quarter, we had a benefit which was like somewhere in the high single digits. And this is a litigation that goes back on export benefits from the middle of the last decade. It was pending in the courts, and we got a favorable ruling on that, and that is what has resulted in this gain.
Okay, so in terms of higher single digit in $1 million?
In $1 million, yes. I'm sorry, yeah, I should have said that.
Okay. Understood. Second question is more on a conceptual side. When we are investing some $360 million for this 240 KT recycling, apart from the decarbonization or emission reduction benefits, what sort of ROCs does these investments throw in? Or is it purely a decision based on sustainability-linked targets?
Now, this is, I think this is where our business really intersects very, very well with sustainability. This will reduce, as we said, and you just mentioned, it will reduce carbon emissions by 1 million tons for Novelis. And the reason it's reducing 1 million tons is because it's replacing high primary produced sheet ingot. And so this will not only reduce carbon emissions, but again, as Deb had just highlighted in the recycling benefits in South America, this will have a benefit, a financial benefit to Novelis in the ability to source scrap and produce sheet ingot for the process of automobiles in a significant way. So it's both a very attractive financial investment as well as a carbon reduction investment.
Is it possible to share some directionally some numbers as to what sort of hurdle rate or returns these investments meet?
No, I mean, we're not going to get into project by project, but I think we've been very clear that we look for hurdle rates that are well into the teens as a baseline for investments.
Understood. If I may just squeeze in one question on the can segment. So overall, if you see last 2-3 years have been quite good, and the market has been quite tight. Just want to understand what would be our average contract period, and what proportion of your overall volume is reflecting the current market tailwinds, and what proportion of our volumes we are still selling at lower conversion spreads given the legacy contracts.
Yeah,
direction
Sure. In our beverage can in-market business, our contracts are minimal multi-year contracts. They're all contracts that are going to be re-upped, not all at once, but over time. So it's really hard for us to sit here today and give any precision to that. What I can say is that, as you mentioned, there is tightness in the marketplace. We see it, for the most part across the world. We are seeing ability to contract at higher prices and for longer tenures, and that continues to be a very attractive market for us to work with our customers and think about further investments to support our customers.
Understood. Thank you so much, and all the best.
Thank you.
And our next question comes from the line of Amit Dixit with Edelweiss Singapore. Please proceed.
Hi, good evening, everyone. Thanks for taking my question. The question is basically on the capex that has been scaled back a little bit. So can you let us know the reasons for scaling it back? Is it due to the working capital lockup that you have seen, or is it due to the demand postponement? I mean, and what would be the impact of this on earnings, if any?
So, the postponement is not because of cash getting locked up in working capital at all. I mean, you can see that our balance sheet is not anywhere constrained, for us to be able to do what we need to do. The reason is purely that with all the COVID surges, it has not been able to be possible to keep the pace of capex. And so we have had to slow down some of the things. Now, really, it is not impacting anything. We will still be within all the right timelines, and this is not going to have any material impact, or rather any impact at all. But to your specific question, there has just been a bit of slowdown because it is not possible for contractors to, sort of travel across the world sometimes due to all the restrictions, and even locally, COVID restrictions in general have slowed the pace of activities. That's really what the reason is.
Just to follow on this, the supply chain part of it in particular, in OPEX, we are showing 82 million impact due to supply chain disruption and inflationary environment and favorable metal benefits. So is it possible to quantify the supply chain disruption specifically, and how do you see it going in Q4?
Yeah, so I'll try to be as explicit, but quantifying a specific number of supply chain is really a bit challenging. So let me say this, that the biggest part of the supply chain disruptions have impacted us in North America. And that is why you see a little bit of a softening of numbers in North America. The reason why I don't want to quantify the very specific impact is that it travels across different parts of the P&L. So on the one side, we have supply chain slash inflated related costs. On the other side, we have some pass-throughs of that happening, because in a good number of cases, we are able to make customers share the burden of the supply chain costs. But net, what we can say is that at this moment, supply chain is causing a disruption. Our North American operations in particular are bearing a larger share of that short-term headwind. And to a good extent, we are able to work with customers to be able to bear the costs of that. This is a space that we have to watch. These are short-term headwinds that we will have to live with for some time.
Okay, understood. Thank you and all the best.
Thank you.
And our next question comes from the line of Vishal Chandak with Motilal Oswal. Please proceed.
Yeah, hi. Thanks for the opportunity. My first question was related to the strike that you mentioned in Asia. So if you could please elaborate on what happened, how long was the disruption, and what are the chances of that recurring or avoiding that in future?
Yes. So it was a labor strike at one of our facilities, our Yeongju facility in South Korea. It lasted 26 days. We were able to, for the most part, cover the quarter shipments for our customers through finished goods that we had at the plant, and then we're making up some of that volume through delay in some maintenance time frames and working through some holidays. So in the third quarter, it will not have a material impact. There is still some catch up in the finished goods that will occur in the fourth quarter, so a bit of a headwind that we got to overcome in our fourth quarter. As far as avoidance of that, I mean, I think there was no winners in this case, and certainly we want to be more proactive with the labor unions across the world, not just in Yeongju, but across the world, to make sure that we're being fair, transparent, and we can avoid these types of disputes going forward.
Sure, thanks. Is that the reason for a 15% sequential decline in your shipments in Asia?
It's part of the reason.
This decline largely was because of materials getting stuck at port, a little bit because of the strike, but I would say that the larger part of the reason for the softer shipments in Asia this time was materials just not moving. I mean, we had a material volume stuck at the ports because ships were not so easy to get, and so it's really supply chain, but to some extent it was also because of the strike, and the strike effect will run into Q4 because, the production that we were not able to do in Q3, to some extent, it will flow into Q4.
Right. So my second question was with regard to the EBITDA per ton at Europe. That has contracted pretty sharply in this quarter on a sequential basis if I look at it. So any specific reasons, and how should we look at it going forward?
So on a sequential basis, you have to be mindful that shipments are a little bit lower in this quarter. We had also some very specific headwinds from energy costs, and that is really related to not just the general inflation, but also because of geopolitical factors. So the Ukrainian-Russian tensions, because of which gas prices, energy prices have gone up severely. It is not just the normal inflation, it is a more severe impact that is happening in Europe. And so we are seeing this short-term geopolitical headwind. So one is that you have to keep in mind some seasonality. Quarter 3 is seasonally among the low quarters. Number one. Number two, the reason that I just mentioned, just just made it a little more, acute, if I may say, in this quarter. Energy inflation is the second biggest reason besides the seasonality.
Do we expect a similar kind of inflation on the energy cost for the Q4 as well, or should you, is it possibility of mitigation somewhere?
Yeah, I mean, I wish we could predict all these geopolitical issues, but directionally we are seeing some continuing short-term headwinds when it comes to energy prices. So just the way it looks right now, the energy prices will just keep staying at inflated levels, at least for the time being.
Sure. Thank you very much.
Thank you.
And as a reminder, to register for a question, please press the 1 followed by the 4 on your telephone. And our next question comes from the line of Satya Jain with Ambit Capital. Please proceed.
Hi, thank you for the opportunity. A couple of questions. First on South America. You have been reporting extremely strong numbers for the past few quarters, even if we take into account some litigation benefit and FX benefit. What are the barriers to entry? Why is somebody not looking at this number and saying, I want to put up capacity? Is there any competitive advantage Novelis has, or are there any barriers to entry in that region?
Yeah, so in Brazil there are import duties currently at 12%. They are constantly being reviewed by government down there, but they've been at 12% for some period of time. These are not small capital investments, so I think the fact that we already have a very significant investment in our Pinda facility down there, and our ability to expand that facility gives us a competitive advantage as long as we stay up with the market growth down there. And so, these are strong results. It's not all driven purely by pricing. It is driven a lot by the high recycled content down there too, and higher, as Dev said earlier, higher metal prices help the spreads as well. We continue to see a very favorable market trend in this market that we'll find ways to continue to serve our customers.
Okay. Secondly, on the recycling bit, Novelis did announce that auto recycling investment, UBC recycling is already pretty significant for Novelis. If you have to look at your entire portfolio, where do you see incremental opportunities for increase in recycling? In what regions, and what could be the constraints for increasing recycling beyond what you have in certain regions and products?
Yeah, so we see opportunities across the world. So we're announcing recycling capacity in China with that integration project. We've announced the project in North America that we'll get started on and will commission in 2024. Part of the expansion down in Brazil was also for recycling casting, and we see further opportunities in Europe. So it's really across the board. We just need to pace our investments, and we need to also work to ensure, like when you start to talk about end-of-life recycling of automobiles, we need to ensure that supply chain will be there in order to get the scrap back into our facilities as well. So it's not just about capital investments, it's also about ensuring both through legislation and through appropriate associations working on these supply chains to ensure enough of the material doesn't get into the ground or go into the wrong wrong type of recycling. We want to get it back into the circular recycling where it goes right back into the same product over and over and over. So lots of opportunity in this space.
Okay, thank you.
Mm-hmm.
And our next question comes from the line of Binikin Parekh with J.P. Morgan. Please proceed.
Thank you very much, sir. So my first question is on South America. Against the volumes of rolled product shipments of 157,000 tons, 157 KT in this quarter, what is the breakup of in terms of the metal sourcing? Because if I understand correctly, Novelis does operate captive smelters in South America. So how much of this will be basically through internal sourcing of captive aluminum?
No, there's no captive aluminum. We are not operating any smelters in South America, Pinakin. That's a misunderstanding. So metal procurement happens from outside. It's a dominantly can business, so therefore it has a very, very strong recycling content. And the largest majority of scrap is produced, or rather is procured locally in South America. Sometimes, we also have to import scrap. So that is our largest procurement. But to your point, no, we don't have a smelter, and there's no captive aluminum that we source in South America.
Yeah, the two smelters that we did have, we've shut those down years ago, Pinikin.
Sure. So, but when we look at the South America profitability over a longer period, 16 to 20 quarters, the South America adjusted EBITDA per ton seems to be very closely correlated with the LME aluminum price. So, compared to, when aluminum prices were below $2,000 a ton, the South America profitability was below $700 a ton. And the rise in aluminum has driven this. So broadly, are the operations, the way the scrap is sourced, the way the business model works, is that the profitability in South America basically follows the LME aluminum pricing?
Well, you can say that. It's a fact of life, right? I mean, there's a large recycled content, and metal prices going up does create a nice tailwind. So that's a fact of the business, right? But you have to understand South America also from a market context. And as we see growing demand for can, and what I mean by that there is a very, very consistent adoption of cans in the packaging mix when it comes to beer. This has been an unfailing trend, quarter after quarter after quarter, right? So really, you have to think about South America more from a market perspective. We have a very favorable environment on the switch of packaging from glass to can, and and that's why we added capacity, and we will over time need to really keep adding capacity in this market as the market grows, and as you scale up, your costs don't scale up in the same proportion, right? So therefore, from a profitability perspective, because of the favorable demand conditions in the market, we expect this market to continue to be a very strategic and a nicely growing market for us.
Sure. So just to, a final question on the South America thing is that, because if we look at the last 6 quarters, starting from second quarter F21, the adjusted EBITDA for Novelis went from roughly $490 to $540. But if we exclude the South America operations, it's broadly been flat. Now, this is the period where LME aluminum prices went higher. So somehow it seems that the aluminum prices, the cost inflation is impacting all the other regions, but South America is benefiting from higher aluminum prices. Would this trend broadly remain if we are in an inflationary and higher aluminum pricing environment for the next 1 to 2 years?
Look, I think that you have to really think about the last 2 years in the context of COVID, and all kinds of things have happened during this time. So to try to make a judgment that, outside of South America, we have remained flat, well, the point is that the last 2 years don't represent any normal, right? So that's one underlying thing to keep in mind, right? Now, if you just compare the last couple of quarters, with rising inflationary pressures, and also supply chain disruptions, and I would focus more on the supply chain disruptions. We would have been selling a lot more. So when you talk about profitability, the last few quarters, the last about 4 to 5 quarters, have now already seen the impact of of semiconductor shortage in the auto segment. Had it not been so, North American EBITDA and EBITDA per ton would have been far higher. So would it have been the case in Asia. So what you need to remember is that the last many quarters don't represent a normal situation from the point of view of chips availability. We told you the impact, 20 to 25 million a quarter, and most of that would be in North America. A little bit of that would be a decent share of that would be in Europe and in Asia. So if you sort of really try to normalize all these factors, then the picture would look different. And you have to think about the future from a more normalized perspective. Semiconductors issue will come to an end. We can discuss the timing of that. Supply chain issues, the way they are today, cannot be a permanent feature. And as soon as we see some normalization of that, some of the transitory inflation because of geopolitical factors, that cannot be forever. And once these things normalize, you will see how strong the other markets start to behave in time. Because demand conditions are excellent across the board in all our segments.
Understood. No, this is very clear. Thank you very much for this.
Thanks, Pinakin.
And our next question comes from the line of Matthew Fields with Bank of America. Please proceed.
Hey, everyone. I just wanted to touch a short, my first question on that short-term loan that you took out in January. I guess you repaid the 22 secured term loan with the proceeds. Just wanted to sort of flesh out your thinking on kind of why the short-term loan, why not a longer-term instrument? It seems like you're paying off secured with unsecured, so maybe mix of secured versus unsecured, where you want to take the balance sheet from here, kind of thoughts like that, please.
Yes, Matt. So actually this 315 is a pretty straightforward transaction. We were getting a low-cost unsecured facility, and because it was low cost and because it was unsecured and because we know that we have to repay the remaining 2022 term loan, we thought, let's take this on. It gives us some dry powder as far as liquidity goes because, the 2022 term loan is maturing in June. This is a one-year facility. Just given all that is happening around us, higher metal prices, more needs for working capital. So if we are getting this at a lower cost, it just gives us a low-cost dry powder. And that's just the only single reason why we did this transaction, this short-term transaction. Otherwise, everything is exactly as we have been describing. We had told you that, we will be repaying $2.6 billion of loans, of which we did almost everything last year, about $2 billion, and this year was the $600 million we said, largely of the term loan, and so we are on track. Out of that 600, we have already repaid, 300 with this unsecured bridge borrowing, and the balance 300. We will see how the conditions are. If metal prices remain elevated and working capital pressures continue, we will just take this until November and then repay it. If not, and things start to look more normal, we will just repay this because this is repayable. The 315 is repayable without any conditions. You see, so it's a pretty straightforward transaction. No change in direction on anything. We don't see ourselves coming into the market for the next many years. We are going to be generating enough cash to take care of our needs. So the story remains the same as we have been describing in the last couple of quarters.
Okay. And I know you touched on kind of the energy situation in Europe with, vis-a-vis higher costs, but, as we're seeing kind of, the continuing scarcity of gas and higher prices, we're seeing more shutdowns of smelters. Are you seeing an impact on the physical shipments in Europe, and kind of might that really crimp supply? In addition to just seeing higher costs, like when do we start seeing an effect on actual operations from energy shortages in the region?
Yeah, so I haven't told you the other side of the equation, and I should, because we have PPI clauses in a good number of our contracts, number one. Number two, we also, have annual price increases in particularly the specialty business. So we are getting very favorable prices from the contracts that are getting activated as we speak. So from this quarter, we will also see the benefit of increased prices and some pass-throughs. So there's always a bit of a lag between pass-throughs happening versus when the costs come in. So it is not like we are going to bear the entire brunt of every cost increase. That's the point I'm making. Now, specific to energy, the situation is a bit abnormal. And, we really don't know how the geopolitical forces are going to play. But we need to be prepared, in short, for some short-term headwinds on this. It's not like, all this geopolitical related energy costs can be passed on to customers. So all that I can say is that in part, because of, all the annual contract renewals and some lag impact of inflation clauses playing into the contract, we will see a decent mitigation, but not all the mitigation. We just hope that some of these external noises settle down. I hope that helps.
Yeah, that does help. And I'm sort of on the physical side of the aluminum, and maybe this is more of a problem for your suppliers. Are you seeing reduced flow of metal, and in a sense, are customers kind of worried about, shipment volumes due to the sort of scarcity in the region? Is that, I understand the impact on prices, but, are you seeing metal flows kind of impacted?
No.
Okay.
We are feeling very good. The flows are good. We have been able to keep all our customer obligations. No, that's not a concern.
Okay. And then, maybe a bigger picture, longer term question on the recycling side. You've obviously announced, recycling goals and sort of reduction of prime aluminum. So have your peers. Many of them are kind of, also investing in more recycling capacity. As you see kind of, and I know maybe the auto closed loop may be a different function because that's more of a closed loop system and less impacted by external trends. But as you see, everybody kind of, investing in recycling aluminum, do you worry that the cost of kind of UBCs will go up and impact scrap spreads over the longer term?
Yeah. First, I think it's a good thing that we're all investing. It's the right thing to do from a carbon footprint standpoint for the industry. As we said before, it's 5% of the carbon emissions of primary aluminum. So it is absolutely in the right direction. We're pleased to see everyone move in that direction. With that said, we also all have to work on scrap availability. So as you point out, the auto facility is a unique one, and we can get the closed loop recycling back from those auto customers, but we've got to work on end of life, and we've got to work on increasing recycle rates across the world, but especially in the U.S., where we're running under the 20-year historical average. There's projections of that increasing, but we've got to make it happen as an industry too, and we all need to participate in that part of it as well. Deb, do you want to add anything there?
No, I think that's what it is.
Okay. Thanks very much, Steve, Deb, and Megan, and good luck finishing out your fiscal year.
Thanks, Matt.
Thank you, Matt.
And our next question comes from the line of Ashish Kejriwal with Centrum. Please proceed.
Yeah, hi. Thanks for the opportunity. So two questions. One is you talked about a strike which impacted, not much impacted third quarter numbers, but is it possible to quantify what could be the possible volume impact in fourth quarter because of this? And at the same time, because demand from auto has not increased much, so are we seeing sequential decline in overall volumes?
So, Steve, you want to take that one?
Sure. So maybe I'll start with the second one. So the first question was on the strike and what the quantification of the impact in the fourth quarter is. It will be a headwind. We've net lost about 15 KT of production. We've made some of that up in the third quarter. We'll have to make some of that up in the fourth quarter. We are working through some of the holiday periods, Lunar New Year, to make up some of that. But for sure, there's going to be a headwind in the fourth quarter that we do need to take care of. As it relates to your second question, the auto, we do not see sequential quarter-over-quarter decreases in auto. As a matter of fact, it's actually increasing. We just would have expected it to increase more had there been the availability of the semiconductor chips in the manufacturing of the automobiles themselves. So that's the short-term impact to us. As Dev highlighted, it's in the range, and it has been since the beginning of this fiscal year, $20 to $25 million per quarter impact to our business. And we do see that continuing in the near term. There are some positive announcements coming out from the OEM, so they're starting to feel much better about this. I think Ford announced that they'll see wholesale unit increases in the range of 10 to 15% in calendar 2022 versus 21. I think GM announced somewhere in the 25 to 30%, again, year over year. JLR's indicated that their fourth quarter, because their fiscal year end, is also seeing some improvement. So we certainly have been impacted this year, but we do see some positive signs coming, and it's just a matter of when that comes now over the next couple of quarters.
Thanks. And second question is for Dave. Sir, you have been mentioning that, our sustainable EBITDA per ton guidance 500 plus. But over the last 5 years, despite all the headwinds related to auto or supply contracts, we have been consistently delivering more than $520. So do you think that it's time for us to upgrade the guidance, or still because lots of the improvement which we have seen is just because of South America, and for all the regions, it's maintaining somewhat flattish. So you don't want to change the guidance as of now?
We don't think it's the right time to change any guidance. The reason being that until all the noise in the environment settles down, so for now it is all this supply chain issues and all the chips issues that are creating a lot of noise with some abnormal inflation. I just think that we will hold the guidance of above $500 per ton until some of the noise in the environment settles down, and then maybe it will be time to revisit the guidance. So that is really what I would say for now.
Sir, but this is all the negative noises are there. So once this negative noises comes down, definitely it should increase from the current level. And our current level, if I'm looking at in the last 9 months also, it's more than $540. So when you are saying that noises are going to settle down, ideally it should be higher than the current price or current EBITDA per ton.
Well, you're right. So you're right. Absolutely right. But it's about timing. So until the noise is there, we just want to kind of keep that bit of space for volatility, and that is why we would just like to continue guiding above 500. But you are right. I mean, if all this settles down, the semiconductors issue settles down, some of this supply chain noise settles down, and some of the transitory inflation, particularly the geopolitical issues related inflation, comes in a more contained place. You are absolutely right. So directionally, what we are saying is that there's a lot of strength in the business from a demand perspective, from a pricing perspective, from a richness of portfolio perspective. All these are positives. Until the time the noise settles down, we think it is prudent to maintain the $500 plus guidance, and then in time we will reassess it and come back to you.
Sure. Thanks, and all the best.
And our last question comes from of Sean Wondrak with Deutsche Bank. Please proceed.
Hey, good morning, Steve and Deb, and congratulations on another great quarter.
Good morning.
And I apologize if you've answered any of these, but just a follow-up on one of your later questions in terms of energy costs. Aside from sort of the mechanisms you have in place, what magnitude or what percentage of sort of your energy costs are unhedged or exposed? I think you mentioned on the freight side it was roughly, half your freight cost wasn't passing along. So I was curious how that would work on the energy side, please.
Yes. So let me describe the situation by markets in Asia and in South America. It is really regulated prices, and hedging opportunities are very limited. Now, as far as Europe is concerned, we do have a very strong hedge position. And really, the fact is that energy prices have not gone up in percentage terms. Energy prices have gone up in like multiples. It is all published. I mean, you have it in front of you if you search for it. So we do have a relatively low unhedged portion, but even the relatively low unhedged portion with the current prices, which are like, higher in multiples, 2x plus times, do create a bit of a headwind for us. In North America also, we have some energy hedging, and energy prices are higher, and the unhedged part does impact us. But really today, if there's one area where the concern is the highest, it is just Europe, because of the earlier situation that I mentioned, the geopolitical issue around the Ukraine-Russia implication. So that is really where we are seeing the biggest brunt on the unhedged portion of energy/gas in particular.
All right, thank you. That's very helpful. And then just if you could also talk about maybe, I think you had mentioned labor, energy, alloys, and freight have been sort of the concern areas. Are you seeing anything better on the labor, alloys, or freight side, please?
Well, on the labor front, the headline inflation numbers are going to impact labor costs. So high single-digit inflation in the U.S., for example. So labor costs will have to follow inflation. So will it be the case in other parts of the world? As far as availability is concerned, no, we are pretty good on availability of labor at our plants. We are able to produce and service customers. The thing that is impacting us on the labor side in the U.S. is really our third parties like scrap tollers not being able to keep up their supplies because of smaller businesses facing the brunt of labor shortages, and that is impacting us. That's part of the reason and some of the headwinds that we are seeing in this quarter in North America. Getting scrap from tollers is becoming a bit of a challenge because of their labor availability issues. So on labor, really, one is the headline inflation that will impact labor costs. As we get into this year, we will have PPI clauses switching on, and over time we will catch up with all the cost increases besides the market-driven price increases. But the real thing is that we don't just depend on our labor, we also depend upon our contractors and our third-party service providers, and we see some of those headwinds impacting us.
Great. And I'm sorry, just lastly on freight, if you can comment.
What's that? Can you repeat that?
Sure, just on freight and logistics. What are you seeing there, please?
Freight. Okay, yeah. So freight, yes. I mean, that's another story. So really, freight, for the largest part, it is materials that we have to transport across the world. And if you ask me at this point in time, we do depend upon Asia, for example, to service the North American market because of the high demand and lack of capacity. Now freight charges have also gone up, not in percentage terms, but in multiples. But the good thing about that is that a very, very decent part of that, we are able to negotiate and have customers share the burden because they need the materials. And so we have discussions with them. They are very good with taking a part of the burden. So net, we are able to contain the impact, not eliminate the impact, but contain the impact. So the numbers do carry some burden of the higher freight charges, particularly when it comes to Asia to North America. for the largest part. In general, because of the high energy prices and oil prices, freight cost does get elevated. That's because it just follows, fuel prices. So that is there, and that's part of normal inflation that we are seeing across the world.
All right. Thank you very much. I really appreciate all the extra color there, and it's nice to see leverage ticking down. Good luck next quarter.
Thanks, Sean.
Thanks, Sean.
And Mr. Fisher, I'll turn the call back over to you for any closing remarks.
Great. Thank you, operator. And thanks to everyone for attending our call today. We are pleased with our Q3 performance and ability to navigate the short-term challenges we spoke of, and also with the opportunities we are embarking on to capture strong market demand and advance our sustainability agenda going forward. So thank you for your time today, and please stay safe.